And welcome to the latest Bean Ninjas webinar. Many thanks for coming today. So today we're going to be covering cash flow management and forecast best practice. So my name is Tom Mercer and I'm director here at Bean Ninjas Europe. And for those of you who don't know me, here's just a quick intro. So I'm an ACCA qualified accountant and I joined Bean Ninjas back in 2014. And originally I started as a part-time cloud accountant. But since then, I've worn many hats. So I've been a team supervisor, I've been a team manager, and also onboarding specialist. So I help with setting up the integrations. Each company is very different, so it's really interesting to be in this onboarding section as you get to deal with all the different integrations and how they work and getting them to basically be harmonious with each other. And yeah, basically until I got to where I am now. So apart from being a static accountant, I do like to travel with my work and be as much a remote work as possible. So this year I will be traveling down to Spain in the car again with the dogs for 3 months to spend that time, in the sun. And I like to encourage my fellow colleagues and also clients to do the same. So I'm always sharing tips on visas and things that went really well, or problems that I ran into. So everyone can kind of try to live that lifestyle if they so wish. So today we're going to cover what is cash flow management and why it is important, how cash flow management can help with assessing and mitigating business risks. And as part of that, we're going to cover one of the, unfortunately, things we can't avoid, and one of the most important cash flow things that we need to plan for, and that's taxes and how not to get caught out with them. And then we're going to move on to one of the more important things, especially for e-commerce businesses, and that's inventory cash flow planning. And then we're going to look at other items as well. So depending on your business, you might have different cash flow issues. So we're going to just cover a few of the main ones, so things like affiliate payments, overseas taxes that you might have to plan ahead for, and then we'll finish off with any questions at the end. So to start off, we're going to look at what is cash flow management and why it is important. So basically, cash flow management just boils down to monitoring all the money that comes in from things like sales or any other income that you might have, and tracking that against money that leaves your business via bill payments, paying salaries, taxes, or any other money that leaves your business. So there's one main question I get, and one of the biggest confusions I see is when we do the profit and loss reporting for a client. At the end of the month, it might show like £20,000 profit on their profit and loss, and then the client says to me, "Oh, Tom, I've got that £20,000 there. Why has my bank only got 10,000 in there?" And that's a very important distinction to make between the two. They are related, but they're also very different in the way they work. So, for example, you might have had done a lot of work for a client, invoiced them £10,000 today on 20th of February, but you might give them 30 days to pay that bill. So you don't actually receive that cash until around 20th of March. So that's where the difference comes in between your cash and your profit and loss. Profit and loss is always based on invoice date. Cash flow is based on the actual cash movement date. So as you can see, there can be quite a lot of movement between the two. And that's why your business can look very successful. In terms, if you're just looking at the profit and loss, they can look, they're doing very well. But if they don't have the cash flow management behind that functioning well, then that business could, be very well in danger. In fact, 82% of businesses that do close do so due to cash flow issues. So, it is really important to understand both profit and loss and cash flow, and understand separately how they impact your business. So in terms of a good cash flow management, why is it important? So basically, you need to have a good cash flow to be able to meet all your bills when they come due. Also, it can help save money. So if you have a good cash flow management, obviously you can avoid using expensive loans, overdrafts, credit card facilities, and if you do need to, tap into those facilities, if you have good cash flow management, you're likely to get a lower interest rate than if you've already took out a couple of loans, or you have a history of borrowing cash to meet your demands. So you're likely to get lower interest rates from your banks and credit card companies. Also, it could save you money when paying suppliers. A lot of suppliers offer early payment discounts. It's only a small amount normally, 2 to 5%. But if you're like an e-commerce company, for example, that buys a lot of product over a year, 2 or 5% on each order, that could be a significant saving when you come to do your year-end accounts and you look at it all lumped in together. Also, keeping on the theme of suppliers, if you have good cash flow, you can keep working with those preferred suppliers, so you have more of a choice who you work with. If you have bad cash flow and you're not paying suppliers on time, they might say they don't want to work for you any longer, and then you've got to go out and find another supplier, another provider, and they might not be as good or as reactive as your preferred one. So it's always best to keep everyone happy. And the other important thing as well is it helps you meet tax obligations. So you always want to make sure you're up to date with HMRC and any other taxes that you pay. Basically, falling behind in those does show big business troubles, and HMRC always come in to collect. So make sure you have money set aside for taxes, and they're able to meet those obligations when they fall due. The other good cash flow is to help you avoid legal action. And again, it also helps you be proactive rather than reactive. So instead of people chasing you for money and you just trying, running around trying to pay those past bills, having a good cash flow allows you to plan ahead. So you can actually make plans on how to grow your business and how you want it to function, rather than the function of your business being dictated to you by the cash that you have available. And the last thing, I guess, probably the more important thing, is your health. Basically, a good cash flow is a lot less stress on yourself. It makes you happy overall. You're a bit more free and lighter when you're walking. So, if not for all the others, manage your cash flow well for yourself, so that you can have that peace of mind and enjoy what you're doing as a business. And continue doing it over the long term. Basically, running when you're stressed for cash over a long term, it's hard to keep running a business that way. So we're hitting taxes first, just because that applies to all businesses. So whether you're e-commerce or online agency, unfortunately, taxes is just something we can't avoid, and it's good to pay them anyway. So as long as you plan ahead, it's not a problem for any well-run business. So first off is just be prepared. You have to pay tax each year, so just make sure you keep good records and get those taxes calculated early. So in the UK, your business generally has 3 types of tax. First of all, you have PAYE, which is your payroll. So any taxes related to payroll, like your NICs and PAYE, and these are due by the 19th of the following month. And then if you registered, you have VAT, which is so like sales tax or GST in other countries. And in the UK, you generally pay for full quarter in one go, and that's on the 7th day of the second month after your quarter ends. So it sounds a little complicated, but for example, if your quarter is like a calendar quarter, so it's October, November, and December. So your 31st December return will be submitted on the 7th of February. And then finally, you have your corporation tax return, which is tax based on your profits over the whole year, and that's due 9 months and 1 day after your company year end. So each tax has a different way to budget for it or plan ahead. So when you, for PAYE, for example, when you start to look at hiring someone, there's more to consider than just the actual wage for that person, that salary. You've also got employer NICs that you pay on top of that, employer pension as well, if you're offering a pension. So it's good to kind of look at all of these options to get a full idea of the full monthly cost before you go ahead with any hiring decisions, just to make sure it is within the cash flow of the businesses. So what you can do is there's plenty of online tax calculators that you can use for PAYE. So you can just search one of these and just type in, the salary that you're proposing to pay this employee, and then that will bring out the cost per month that you can expect to pay for hiring that particular person. To help out with VAT, so I've touched on this already. HubDoc is absolutely essential for this when you're VAT registered. So basically the reasoning is if you're putting documents in, well, if you're making payments, we can't really claim the VAT without having documents to back that up, just in case you get an inspection by HMRC. And also, if you're buying from Amazon, for example, some sellers are VAT registered, others aren't. So we need to make sure we're claiming the correct amount of VAT back for you. And you could miss out if you're not providing those invoices and those bills that you do get. So yeah, get those documents into HubDoc. Those go up to 0 and your VAT gets claimed. And then what you can do each month is we can look at how much VAT is accrued for that month, and you can set this aside in a separate pot or jar. So basically these pots or jars, these are, I'm going to refer to two good online banks, and those are Revolut and Wise. I preferably use Wise at the moment, and just for the reason, it has these jars that are really good. You can set one up you can set as many of these up as you want. So you can set one up for your VAT, one up for your corporation tax, and you move a little bit each month. So what these jars are is they're kind of ring fenced. So if you do use your card to buy something, or if you've got a standing order in your bank account, the money that's in the jars cannot be touched. So that money can't be drawn out of there. So that's what I say. Each month, you can get from your accountant or calculate it yourself how much VAT is due for that month. So that's how much VAT is on sales, less how much VAT you claim back on your purchases. So you can move that into this jar, and then at the end of each quarter, you should, if it all goes well, have enough money in that jar just to pay off that VAT. So you're not scrambling to find that money to pay that VAT once the return is done, which maybe actually only leaves you a couple of days to find that money. So it reduces that stress of running around trying to find that cash at that time. And also corporation tax is another one, very similar. So I mentioned I set up a jar for this as well. So a good idea is in each month to set up a corporation tax accrual in your management accounts. An accountant can help with that, and Xero really facilitates making that quite easy. So each month, based on your profits, you will add a percentage for corporation tax and journal that in as an accrual. And then what you can do is let's say your accrual for this month's corporation tax is £2,000. You can then move that £2,000 into a jar within Revolut or Wise or whichever bank you use if they do provide that kind of service. So it's not always ideal for each business to do that. If you're a business that doesn't have use for its cash, it's just building up in a bank, then that's sometimes a good way to look at moving it across. If you are a business that uses that cash on a monthly basis, then you can obviously use it for business operations, but just have it in the back of your mind, and you'll be able to see that figure build over the year. So when you do get to the end of your accounting period and your accounts are done, it's not going to be a huge surprise the amount that you do have to pay. So you can just start planning ahead for that. Maybe in those moments when you can see your cash flow is generally highest in the year, just make sure to hold some back at that point to meet those obligations. The other tip I would always give on taxes is just get the tax returns filed as early as possible. Don't do them too early, because otherwise there may be things that arise after year end that might affect your year end accounts. So just make sure you make sure the year end is finished properly first, and then get those taxes returned as soon as possible, even if you don't intend to pay up until the deadline. So the reason for that is that it gives you a solid figure. You know exactly the amount that you are expecting to pay, and you can start accruing everything that you need for that particular amount. So now we're going to move on to how cash flow management can help with assessing and mitigating business risks. So first of all, you can't mitigate or plan for anything at all without being aware of what the obligation is. So first, you need to put in place some basic cash flow management processes. Just something basic. Every business should have is an accounting platform, like Xero, for example, where they can start tracking their costs and their business expenses and income. So that's your basic platform that you need. And then a good idea to hook to this is HubDoc, which is a document management platform. So basically, any bills that you get, any invoices, you just send them to HubDoc, and this will file them for you. But it will also push your bills to Xero, so you'll have an accounts payable figure. So, for example, at the end of this month, you'll be able to see any payments that are due in the following month. So you can kind of start planning for the short-term cash obligations that you have, making sure you don't spend on anything unnecessary, and you have that cash in the bank ready for the following month to make sure those are paid. So that's an early first step. And even just sitting down, and thinking about cash flow forecasting is a massive step. When you kind of take your head out of running the business on a day-to-day and think for the year ahead, you'll start seeing things that you might not have realised were there before. So you might realise there's deadlines when you start looking at the fuller picture of your business. So always get the basics in place. Take your head out of the main business and just, a couple of hours a week, maybe just start thinking about your accounting and what's going on within your business. Maybe set an hour aside or two on a Friday and just make it a regular thing that you look at your performance on the business and in particular cash flow throughout the last week. So what you can do once you've got this, HubDoc and Xero set up, you can obviously see the payments coming in the next couple of weeks, and then you'll also build up a history within your accounting platform, which you can help to kind of plan for the year ahead as well. So you can kind of you can see patterns for your cash, so you can see maybe if you're seasonal, how much cash you bring in. If your season's in the Christmas period, how much cash comes in, how much expenses go out leading up to that. Because obviously, if your seasonal business normally involves a large layout of cash to buy all the product you need ready for that sales period. A good cash flow forecasting can make sure you have that ready. So when you have this basic short-term forecast, you can start building on this. So there's no need, if you're small or medium business, to pay for an expensive cash flow forecast software. You can either just put this in Excel, or Xero has a good budget management software that you can use. So you can build it within Xero and export it if you want, and you can easily manipulate this in Xero. So once you've got this basic short-term forecast by using Xero and HubDoc, you can build on this by adding in planned cash expenses. So you might know that you're going on a business trip to a conference at a certain time of year. You might know there's an annual payment for software that you can add into a certain month. And you've also got your history from last year, so you can use that to predict what the next year is going to be. So basically, you've got your cash flow forecast. So this kind of helps you to assess the business risks coming up, the payments that you need to be prepared for. And so basically, once you've got this assessment, then the idea is how to mitigate those risks, how to make sure you meet them. And basically, there's three good ways you can do this using a cash flow forecast. So first, you can plan cuts easy enough. Once you've been thinking about your business and you've looked at the expenses, there might be things in there that you can look at and be like, do you still use this software? I see a lot happen where a free trial of a software expires and people start paying for it and they don't realize until we kind of go through and start putting their cash together and their profit and loss, and they start looking at those expenses. And then maybe other expenses that you've kept the software for a while or subscription, and when you see it there, you realize you don't actually use it as much as you need to, and it might not be essential for the price that you pay. So you can cut those out. So that's your planning your cuts. You can also adjust the timing of activities. So as mentioned earlier, if you're a seasonal business or you're preparing for, maybe Black Friday, you know you need to pay for all of that inventory in those months leading up to that Black Friday sale. So any kind of expenses that you have at that time, if you've put a business trip in, maybe it can be moved to afterwards when you start getting that money from those Black Friday sales. You can move maybe a tax payment, as long as you're still within the deadlines. You can move that till after you've paid for your inventory. And things like that, like your dividends as well. You don't want to take 20,000 out of the business and not have that available for back paying for that inventory. So you can adjust the timing as well. And also, you can help start accruing. So if I know I need to pay a tax bill of around 10,000 by the end of the year, I might want to start just putting 1,000 over the next 10 months till we get to the end of the year aside, so that by the time we get there, the money is there for that bill and it can just be paid off. And also, it's also good to help know when to pay yourself. Rather than knowing, just taking money out of business as and when, you can see when your business and your essential expenses are that your business needs, and plan to take that money out for yourself, via dividends at a time when you will be cash rich, or you're not actually needing that cash for certain other business activities. So there you go. So you got your cuts, adjusting of timing, and also accruals that you can start using to mitigate those business risks coming up of not being able to meet a payment. So now we're going to turn our attention to inventory cash flow planning. So for all of you e-commerce owners out there, this is probably your biggest challenge, is just making sure you get your cash flow right for buying your stock. So there are two main problems that you want to avoid, and they're both at different ends of the spectrum. So one, you have stock out, and two, you have overstocking. So we'll look at stock out first, and this is probably the worst thing you can experience as an e-commerce seller. I'm sure most of you have gone through this at one point. So basically this is where you don't have the stock available in the store, and if you don't have the product available, this is lost money. No sales, no cash coming in, and it's lost. I say it's lost money because this buyer is likely just to go elsewhere to a competitor or to a rival and buy the product there, even if it's at a higher cost, just because they might need that product in that particular moment of time. The only way you'd kind of avoid this is if you have a very unique product that the customer is, willing to wait until stock does come back in. So there's some good tips to avoid stock out, and it's just basically revolves around knowing your product. So the first thing is just know your product lead time. So basically, this is how long it takes your product to get to your warehouse and be ready for sale. So if your product does come from overseas, such as China, you would normally have a significantly longer lead time than products sourced locally. When you do contract your supplier, they should be able to give you a good idea of the lead time of that product, how long it takes from you ordering it to you receiving it. So make sure you do get those lead times from them and make a good note of them. And it might be worth lining up a couple of suppliers, and there might be a range of suppliers. You get your general stock from one, but then if you're having a situation where you need stock fast, you might be able to choose a supplier that has faster lead times. So get a few. Don't always just base when you're purchasing on cost. Maybe line up a few suppliers in case of different situations that arise. Also, the second thing you need to know about your products is your product turnover. So this is basically how fast your product sells. So the good thing is in Amazon and Shopify, it's very easy to download a report on how many SKUs are sold per month. So yeah, you can get a very good overall picture of all of the SKUs within your business and how many shift. So what you will need to do is just make sure you have a robust inventory system in place, so you're always aware of the current stock levels. There's definitely softwares that can help you with that, and depending on your 3PL provider, they can generate a report for you monthly as well on the stock that they hold. And also Amazon and Shopify have the ability to tell you the stock on hand as well. So basically, how does that all tie together? So if you divide your inventory by the average number of units sold each month, that will give you the number of months you have stock available for. So you can kind of see the lead time that you have on that stock in your warehouse, and then based on your supplier's lead time, if the stock, if it takes 2 months to sell the stock that you have, and your supplier's lead time is a month, then you need to start kind of ordering that in the next few weeks to make sure that new product arrives before the old product, before the product that you have in the warehouse sells out. So the second one we will, first just to add on, just also, it's not always as straightforward as that, as all things, unfortunately. Make sure you're aware of seasonal variances. So holidays, not just in your country, but also if your product comes from China, for example, make sure you're aware of extra delays that might be caused by Chinese New Year, for example, and other holidays that they have. Your usual product lead time may be extended over these periods, so just factor that in when you're looking at reordering. So the other side of the spectrum is overstocking. So it's important to avoid overstocking because holding inventory obviously ties up your cash. So if you have 6 months worth of stock, then that's a whole lot of cash being tied up, and you're not being able to use that for other business activities that can maybe make better use of that cash. So you can't purchase other inventory, other SKUs that might sell a bit quicker, or more profitable SKUs. So make sure you don't have too long a stock stored in your warehouse. You definitely don't want to tie up cash in slow moving stock, or in low profit margin stock as well. You want to avoid tying up too much there. Even if you're not buying stock, it's good to have that cash available just to pay other providers, maybe contractors, or your tax and things like that as well. So it's always best just to avoid overstocking. And the other side of that is it helps you avoid getting a loan or overdraft to fill in that kind of interim period where you don't have the cash. So obviously there's an interest expense to the business if you are getting those funding sources. And the other thing to consider with overstocking is storage costs. So you'll need to pay much more to a warehouse the more product that you have in there. So anyone who uses Amazon FBA, for example, knows that those costs can be very high. And the other thing that's important to really watch out for, if your product has expiry date, you really need to know your product turnover, because you don't want to buy too much product that won't sell within the expiry date. It's horrible to have to destroy your stock, but the worst is you actually have to pay the warehouse or Amazon FBA to destroy that stock for you as well. So it's like a double cost. There's money wasted on inventory and money paid to destroy it. Other good inventory cash flow tips are just know your profit per SKU. So each SKU that you sell will contribute different amounts of profit to your business. So make sure that you can rank them from highest to lowest, so that if there ever is a constraint on the business, you only have a certain amount of cash available, so you can only order a certain amount of product or a certain amount of products. You can pick between ordering the best product that gives you the best product margin and a lower profit margin product. You obviously want to choose the higher one because that gives you more cash available for you and more profit in your business. The other tip is review your supplier bills against your POs and quoted prices. So I've seen plenty of times when supplier invoices have different unit costs. So it might just be a small difference, which you might consider insignificant. So it might just be a penny or 10 pence on a particular SKU. But when you're ordering hundreds and thousands of these, these individual SKUs individual products each year, it does add up, and your POs can be a lot higher your bills can be a lot higher than what you're expecting to pay from your POs. So just always be skeptical when reviewing those bills. If it's not you, make sure you've got a team member that knows what the orders well and knows what's been ordered, and they can compare the PO and the delivery note against that bill. just to make sure there's not other costs that are added in as well. Products that you haven't received or shipping costs that weren't agreed or anything like that. So make sure you review the bills. And of course, negotiate with your suppliers for terms. So the more you buy from them, the more important you are and the better terms you can get. So either, there's a couple of things you can negotiate for. So I'm just going to throw a few in there. So this can either be discounts when you buy items in bulk. So the more products you buy, the more units you buy, the higher the discount. Or you might get longer payment terms, which might be really good when you're a seasonal business. So instead of having to pay up front for your product, you might be able to get 30 days or just a 50% deposit, and then 60 days later you pay the remainder. So ask your suppliers for terms. It doesn't hurt to ask. They get asked very regularly by e-commerce sellers, so it's not something that will offend them. It'll all be out of the blue as well. And then just kind of tied into that, just keep a good relation with your suppliers. So be friendly and pay on time. If you have a good, easy working relationship, then you're obviously likely to win. There's more discounts and get maybe a preferential treatment in times when you need it. E.g., if you're trying to rush a stock order, get that prioritized because you're approaching a stock out. So keep a good relation in everything that you do. So on to the final section, just other items to budget for. So obviously each business out there is very unique in the way it's set up and the arrangements it makes with its suppliers and people who work for them, and also people who contribute. So we just cover a couple of other things that maybe you should be aware of when planning your cash management. One of these is quite a common one. It's affiliate fees. So you might make an agreement with someone that you pay a percentage of sales to them. And generally what happens with these is there's kind of nothing until the affiliate fees are due. So a lot of people just say they pay the affiliate fees over the year. So basically what happens, I see, is people get to the year end and then calculate the affiliate fees then, and then make the payment. So this is it's a bit impactful on cash flow because as the business grows, those affiliate fees could become quite significant. So it's a good idea just to calculate those each month as you go, and also add an accrual to those for those into your monthly management accounts, much like you do with the corporation tax. And the other benefit of that is for example, if your year end is at the end of the calendar year, and you agree to pay your affiliate fees for the calendar year as well, you won't get the tax deduction benefit for those affiliate fees. So normally you might pay those in January, for example. So even though you've accrued those affiliate fees from January to December of the year before, unless you enter them into your monthly management accounts, it won't deduct from the profit, and therefore it won't reduce your corporation tax. So it means you have to pay more corporation tax earlier, and then you'll get the benefit of those paying those affiliate fees in the following year. So it kind of it brings your payment forward a year, which in terms of cash flow, you always want to have as much cash as you can in hand as early as possible. So add an accrual each month for affiliate fees, and I also recommend shorter periods. So instead of basing these on annual or 6 monthly, maybe you agree to pay affiliate fees every 3 months, and it just helps not having to dish out such a large amount as you go. Break them down. Other items just to look at as well is where you're selling. So you might be happy selling in the UK, and that's all comfortable. And then you might start selling overseas, where you'll start looking at us, or if you do expand to USA, you'll have sales tax there as well. So I'd say 6 or 7 times out of 10, people ignore the liabilities and just sell. What I would say is preempt this, get everything set up correctly in advance. So make sure you've got your tax registrations set up, because when you do register, they can claim back the tax from previous periods. So you could be hit with a very big tax bill straight away if you do leave it. So as with everything, be prepared, preempt, and just make sure you're above board with when it comes to taxes. You don't want to fall behind because they can be quite aggressive in making sure they do get the taxes through.